All right, next we're gonna explore GAAP a little bit more. Remember, it stands for Generally Acceptable Accounting Principle, and these are qualities and principles that govern accounting, the accounting cycle. So based off of these qualities and principles, we're gonna arrive at the financial statements. So these qualities and principles drive essentially the entire course. So, what qualities must financial information have to make it useful for decision making? The first one is faithful. This means truthful, meaning it is complete, free of error, and neutral. It's unbiased. This is very important because if there's errors, then it's not faithful. Or if we're preparing financial statements with bias, it's not faithful, right? So remember, financial statements are used to make important decisions for investors, shareholders, or the banks, creditors, right? So if it's not faithful, then they're going to be making the wrong decisions. Next one is relevant. This means that the financial information that we have within our financial statements are applicable to your decision making. So it helps you predict the future and or confirm decisions you made in the past. That's very, very important. If it's irrelevant, don't even put it in there because it's not going to impact our decision, right? Comparable is very important. We'll talk about this more in detail when we do examples very soon. So essentially, we could compare the same business from year to year or between two different businesses in the same industry. So we're comparing it on an orange to orange basis, not an orange to apple basis, right? So we can make informed decisions. Verifiable simply means that anyone else that prepares the financial statements on their own can arrive at similar amounts. So we can verify the numbers. Timely means that information is provided quickly. So meaning we want to issue financial statements at least once a year. Public companies who trade on the stock exchange have to issue them even quarterly as well, right? So as information is less, sorry, as information gets more old, is less useful, right? Because it also becomes outdated as well. Understandability simply means that we get straight to the point, it's clear and condensed. Essentially means that the everyday individual can understand it. So we're going to dumb it down as much as possible. Let's actually go through some questions. So PQ13, we're going to skip that because we just talked about it. So let's jump straight to PQ14. Okay, so for each of the scenarios given below, name the qualitative characteristic that you think applies to indicate if that qualitative characteristic has been violated, not followed, or followed. Be sure to explain why you think that is true. More than one qualitative characteristic may apply. So, ABC Company has always included a 12-month period from the beginning of January to the end of December in its financial statements. This year, because December sales were very poor, the business has included 13 months from the beginning of January to the end of the following January. So there's obviously a lot of red flags in this one. The first one being faithful. So this is violated. Faithful is violated because the information is not free of error. They're literally adding an extra month in there because December sales were very poor. So they're not being faithful at all. The next one that's being violated is relevant. So essentially, the additional month is not useful for decision making as it did not happen within that year. So why are we even putting that in there? It's irrelevant. Remember, we're talking about that one specific year, right? The next one that's been violated is comparable. This is violated because last year was a 12-month period, now it's a 13-month period. How are we supposed to compare them? Remember, comparable means to compare the same business from year to year. In that case, that's violated. All right, let's look at the next one. HDT Company is a new business that just started out. At the end of the year, the business's accountant checks out how other businesses in this industry are recording their business transactions and ensure HDT uses similar policies. This one's a little bit different, right? So they're not doing anything wrong. The new business starting out, they're looking to their industry competitors and they're kind of following their policies, right? So that you could do that. In that case, comparable is followed. So essentially, this is followed because now we could compare our business with our competitor, and there you go. So remember, one of the definitions of comparable is we could compare between two different businesses in the same industry. So we're following that, right? Now the next part is DHD company has not produced financial statements in 2 years. The bank has asked repeatedly, but the owner of DHD company has ignored the bank's request. This one is violating timely. Once again, information is getting old, so it's less useful, right? And they're also violating relevant because the bank needs these financial statements to make a decision, right? And it's not being provided. Remember, the banks need this to make a decision if they want to lend out money to the company. And without the financial statements, they cannot do that, right?